tonight we are going to be looking at 3 walls of defense against the IRS, plus renovating, buy, and hold properties. Can everybody see my screen okay?
Barry, your screen looks beautiful.
Thank you. Thank you. Appreciate that. Oh, and Becky says, nice music, thought, laugh out loud. Okay, Becky, that one's on me. All right, so we're going to move on here. I am the Wealth Building CPA. For those of you that don't know me, my name is Aurora, and I am a real estate investor, and I've been a CPA for 18 years and a real estate investor for 11 years. I own about 11 properties of my own. My primary strategy is buy and hold. Okay, I'm going to put everybody on mute.
Muted.
All right, I've muted everybody because we're having interference on the call. I own real estate investments across the East Coast. You know, I don't just invest in my backyard. That's actually the reason I got together with TJ, because I also invest in Pittsburgh. And I help people like you to prepare your taxes both online and offline. And as TJ mentioned, to those that were on the call prior to the webinar, our greatest joy comes from helping people. It's not just about the money, but it's also helping you to build your wealth, making sure that you don't have any financial stress, and also being truthful. You know, I'm a Christian, and TJ's a Christian, and we delight in helping you to invest in real estate, but from the position of truth. You know, there's a lot of gurus out there who would, you know, try to sell you a home study course or get you to come to a boot camp or get you to pay this money and that money. And at the end of the day, they're not really helping you to build wealth. Here at the Wealth Building CPA, and then also with TJ Bencho's group, we are here to help you build wealth. So we will tell you the truth. We're going to tell you the good, you know, the bad, and the ugly, because we know that if we tell you the truth, we ultimately would help you to build wealth. Our special guest tonight, I'm so happy to have TJ back. He's been in hiatus for about 2 months. He just had a baby. Congratulations, TJ, again.
Thank you. Thank you.
TJ is the co-owner of Aurora Real Estate Investment Services, which is family-owned, and he operates a business in Pittsburgh. He provides hands-off real estate investment opportunities for you. And let me tell you, one of the things that I love very much about TJ's team is when you work with them, it really is hands-off. You know, he will show you the different things that need to be done, from buying the property to managing the property to finding, you know, financing for the property to helping you, and that's why we work together so well. And they have a proven system that works, so you take the guesswork out of real estate investing. This is the nice Bencho team. This is so cute. That's Tom and Amy. That's TJ. And that's Betty, and that's Valerie, and this is, who's this person? This is Nick.
Nick's my cousin. He's our newest addition.
Yeah, because I was going to say I haven't seen him before. Okay, that explains it. Okay, and TJ, why don't you go ahead and tell the team about Aurora Real Estate Investments?
Well, guys, I should have. I'm really disappointed in myself. I should have put had a picture on there of my new son, Luke, who's 7 weeks old. So we're very happy to have him in the family, and he's a blessing. We are, as you can see, we're a family-owned and operated business. I think that you get that from the pictures and the description of who everybody is. My family's been investing in real estate in Pittsburgh since 1925. My family and I own over 70 of our own investment units. We invest in A neighborhoods, B neighborhoods, and C neighborhoods. We invest across a wide range of neighborhood types, which we're going to talk about tonight, the different types of neighborhoods. What we do for you, the investor, is we do everything you need to invest in real estate from A to Z. We allow you to continue to live the life you're living today while growing your wealth through real estate. What I mean by that is we build a relationship with you first and foremost. That's the most important thing about what we do. We get to know you. You get to know us. We educate you on Pittsburgh. We invite people to come out and take a tour with us, spend a whole day with us so you get to know us and really see what we're all about and meet our crews and our family. Then we go, once we find out that we're a match and we find out what you're looking for, we actually go out and locate properties specifically for you. We have no inventory. We go out and search for deals that meet each one of our investors' criteria specifically. We perform a cash flow analysis, determine a cost of renovation. We provide you with a whole pro forma of what this property is going to provide. You do your numbers. When you buy it, we make a finder's fee at that point. We also renovate the property for you. I'm a licensed contractor. And when the property's out of renovation, we also facilitate the property management. I'm also a licensed property manager. So basically, we do everything you need to invest in real estate from start to finish. It works out good for a lot of people.
Great, thank you. And now I'm going to tell you guys about the Wealth Building CPA. I've been in the industry for so many years, and like I said before, I've been a CPA for 18 years and a real estate investor for 11 years. So with this combination, I pretty much know most, I wouldn't say all because we're always learning, I pretty much know most of the things that you need to do to succeed as a real estate investor, whether it's with the tax preparation, or it's with entity structuring, or it's retirement planning, or it's with, how to structure joint ventures or finding the money for your deals. That's the WBCPA advantage. One of the things I want to go through real quickly before we get into our conversation for this evening is I always want everybody on this call to know that if you're going to succeed in real estate, you need to have a wealth building plan. It's not just about buying a property, making $10,000, $20,000 from a wholesale deal, and then turning around and taking vacation. We're not saying you shouldn't take vacation, but you need to have a wealth building plan of what you're going to do with the money. You need to have a plan of how to even generate the money, and that's why we look at 8 stages of building wealth. And no matter where you are, I want you to take this to heart, that these are the things that you need to do if you are going to succeed in real estate. And I didn't come up with these stages, just off the top of my head. It's just based on years of experience being a real estate investor, working with other investors, and seeing, the things that have been lacking over the years. We actually came up with this wealth building plan at one of the real estate clubs that I attend. So the first thing is we need to do a financial needs analysis. Where are you today? Do you have a regular job? Are you retired? Do you have a retirement account? What is your real estate goal? What is your real estate strategy? What are you planning to do? Is it going to be wholesaling? Is it buy and hold? Like me, and then like the service that TJ offers. Are you going to be doing notes? Are you investing in commercial real estate? Are you looking at tax liens? All these comes under the financial needs analysis questionnaire because we want to get a crystal clear view of what your goals are, because with that, it helps us now in the rest of the stages to set the pace for what you need to do to build your wealth building plan. And then after that, you need to look at tax planning. The joke that I tell people is, most of us worry about setting up LLCs for asset protection more than we worry about tax. But guess what? You are 100% more likely to pay taxes than you are to get sued. So that means that you need to worry about tax planning and preparation. One, there are many loopholes that are out there and available to real estate investors, but also it's also the way that you prepare your tax return. We don't necessarily want you raising an IRS audit flag, getting into tax evasion schemes. I do have an article on my website where I talked about Wesley Snipes and what happened with him and, bad advice. And he did not pay taxes for a couple of years. That's not what we're about. We just don't want you to pay more than your fair share of taxes. We make sure that all the loopholes that are available to you as a real estate investor, that you're taking advantage of them, and that you're also planning for your taxes ahead of time. April 15th, which, this year was April 17th, is your tax filing deadline. But most investors, you need to know that December 31st is your tax savings deadline. So whatever you need to do, it's not just about meeting the April 17th deadline. We want to make sure that you're also saving on taxes and planning for taxes. That's what we do on this stage. The next stage, stage 3, is entity structuring and formation. We just had a question on the call, what the best structure is for real estate investing. During this stage, we take a look at your real estate strategy, and then we look at how that strategy, what kind of asset protection strategy it needs, what kind of tax reduction strategy it needs, what kind of compliance requirements, and then we come up with the best entity structure for you. And after that's done, then we look at registering the business and setting up your books. During the business registration, we go over things about, whether or not you should be using your home address, which the answer is absolutely not. Not using yourself as a resident agent, what states to register in, and then also helping you to set up your books. And then we do business analysis meetings. That's actually going to be coming up for my wealth building clients May, June. And during this meeting, we take a strategic look at where you are. Okay, you rehabbed 3 properties last year and you made $80,000. What did you do with that money? What's working and what's not working? You've sent out yellow letters. That's your marketing plan. Is it working? Do we need to revise it? You've attended, different boot camps out there, and you've spent maybe $10,000, $5,000 on education. Do we now need to use that education, or do we need to acquire more education, or do we stop the bleeding? I've seen a lot of people spend more money on education and not really anything in real estate investing. You learn real estate by doing it. So these are the things that come up when we do the business analysis meeting. And then we look at investment property purchasing, which is a segment that TJ is going to be covering tonight. What real estate strategy are you focusing on? And if possible, we put you in touch with other real estate investors that would help you in that strategy, whether it's buy and hold or wholesaling or tax liens. Because I work a lot with other real estate investors, I pretty much know somebody that has one real estate strategy and able to lend their expertise on what you need to do. And then we look at retirement planning, how to use self-directed IRAs, how to set up a solo 401k so that you're using your retirement money and managing it yourself rather than, allowing somebody else to do it. And I don't know how many of you have played the cash flow game, but they usually say, wow, you're working with a broker when they're broker than you. So that's the joke out there in terms of working with a broker. You do need to be in control of your retirement account. And then the last thing that we look at is year-end tax planning. Like I said, April 17th is your tax filing deadline, but December 31st is your tax savings deadline. So usually November, December, I'm working with my clients to make sure that we put things in place before the year runs out on how to save on taxes. The Wealth Building Program is a 12-month training program, and it takes you step by step the things that you need to do to run a successful and efficient real estate business. We developed this program after working with other business owners and real estate investors because we realized that, you have to know exactly what needs to be done. Not everybody succeeds in real estate. Not everybody goes into real estate investing and makes money. So there must be a program, there must be a system that needs to be put in place. And our goal is at the end of 12 months of being part of our wealth building program, that you would be able to understand exactly what you need to do to succeed in real estate. Today, we're specifically going to be focusing on stage 2. We've been doing that for the past 3 months, tax planning and preparation. And today, we are going to be looking at, the 3 walls of defense against the IRS. So in terms of IRS audit prevention, there are many ways to reduce your chances of being audited by the IRS. One thing to keep in mind is, while a lot of people are afraid of getting audited, just know that there's a 5. Okay, somebody said they can't hear me, so I'm going to try to speak up now. Please let me know if you still cannot hear me. I apologize about that. One thing that we want you to keep in mind is that, while, the IRS act as a bully, when they send you a letter and tell you that they're auditing you. A lot of people get scared, a lot of people get worried. But, really, if you look at it, it's a very small fraction of the population that gets audited. So one of the things that we need to look at is ways to reduce your chances of being audited. So there's definitely certain red flags for certain industries and filing behavior. So you have a greater chance of being audited if you're a real estate investor and a business owner. And the reason why we're talking about it now is because you are able before December to put things in place. We're able to put things in place before the year runs out. So we're going to look at some of those tips on how you can avoid the red flags. One of the things that we say is try not to use whole numbers on your tax return. For example, if let's say you spent $5,000 on advertising. Maybe it was $5,243, but sometimes you end up just saying $5,000. Those numbers look suspicious. So those are the kind of things that we want to watch out for when we are filing a tax return, that you don't use whole numbers. Avoid using Schedule C for your business. And Schedule C, especially if you have a single-member LLC, because if you have a single-member LLC, that's the reason why you would file a Schedule C. That's a huge audit flag. Schedule Cs tend to be audited 95% more than all the other forms. So that's the reason why we suggest that you don't file a Schedule C. You want to stay away from a Schedule C. Maybe using a multi-member tax return such as a 1065, or filing an election to do an S corp. I'm still hearing that there's a shuffling of paper and background noise. So let me send out a message out there. Let me try to mute everybody. Give me a second here. Okay, I've muted everybody, so I'm the only one speaking right now. And then when it's time for TJ to come on, I'll put him back on. Please let me know if you guys are still hearing the shuffling of the paper in the background. I apologize about that. If you file as a partnership or S corp, you also need to take that into consideration. You don't want to raise an audit flag if you have education expenses. Education expenses are considered costs that you need to amortize, because it's expected that you would get the benefit of it over a period of time. Home office deductions can raise suspicions. And the reason why a home office deduction can raise suspicions is because most times when you think about the home office, you have the home mortgage interest, the taxes, the insurance, the purchase price of the home, and all of that. If you are using a Schedule C, or you are filing a Schedule C and you did not generate income, that means that you're going to be taking a deduction for a home office to the extent of the home mortgage interest and taxes. That can raise an audit flag. So one of the things that we usually suggest is you can still take the home office deduction if you file a partnership or corporate return. There's strategies to do that. But you want to completely avoid using a Schedule C if you plan on taking the home office deduction. Again, remember that you can only deduct the home office expenses if you use part of your home exclusively for business. It has to be exclusive use. So you can have a couch in there and TV, watching TV and all of that. It has to be exclusive use where you use that space strictly for business. Ensure that your return numbers match the 1099s that you receive from your broker and employer. For example, if your 1099 from your broker shows $26,987 in proceeds, make sure that the proceeds on your Schedule D is the same amount. So if you get a 1099 miscellaneous, if you're a realtor, that it matches the same amount. Because if it doesn't match, you're going to be getting a letter from an IRS. Where they're telling you that you did not report your proceeds or you did not report miscellaneous income. So usually what I suggest is to make sure that each of your 1099s are listed separately And then if you have any adjustment to make, you can make that on the tax form itself. But don't say, oh, I'm going to exclude this 1099. Maybe, in some instances, I have clients who receive a 1099 in their name, but it's actually income that is attributable to their business, maybe to their partnership. You still want to list that 1099 on your individual tax return and then go on the tax form and say income picked up under the partnership tax return. So you definitely want to list it even if you're not going to be claiming that income on your tax return. The other thing that raises a red flag is deductions that exceed your business income. You definitely want to take every deduction that you possibly can get, but you need to be very careful in terms of how you take those deductions. For my clients, what we look at is how much income did we have for the year, how many deductions did we have for the year, and then I look at income that you have from other sources. Do you have W-2 income? Is this the only source of income? And what kind of flag would it raise? And then we do plan. That's why it's especially important that you're doing year-end tax planning. Because during tax time, that's not the time to try to figure out, what are you going to do, with your deductions, especially if it exceeds your income. You need to be doing that November, December, so you have things in place. And the next thing that we're going to look at is common mistakes. I'm going to go through these pretty quickly. These are just things that you want to watch out for. For those of you that prepare your own tax returns, I know that, there's a place on the tax return where you have to select the code for your business. Some of us don't take that seriously. We feel, oh, that's not a big deal. And, you can just put in any code there. You need to make sure that you select the right type of code for your business. And the reason why it's very important is, let's say you're a real estate investor, and instead of putting the 5319390, you put in 999 or another industry. When the analysis is being done on what deductions is common for your industry, it's going to be done based on the code that you put in for your business. So you want to be careful and make sure that you select the right business code for your business. The next thing that we look at is failing to elect to amortize your startup costs. A lot of us, like I said, we incur education expenses and, a huge amount of advertising expenses. And technically, you're supposed to amortize it because it's a benefit over the time, but you're supposed to make an election to do that. And what a lot of us do is when we incur that huge expense, we end up taking it all in 1 year. That's something that could raise an audit flag. You want to make sure that if you have startup costs that you incurred in getting ready for the business, that those are being amortized and that you're not expensing them all in the year. Another mistake is not selecting the correct accounting method. There are 3 types of accounting method: cash, accrual, and hybrid. And it's amazing how many people get this wrong. Cash method is you pay taxes on cash that you physically receive, and then you get deductions on money that you physically pay out. Accrual, on the other hand, is when you earn income but you have not yet received it, and you choose to pick it up in income because it's been earned, even though you haven't received it yet. And then hybrid is where you get to decide, for some items you're going to do cash, and some items you're going to do accrual. Whatever accounting method you choose, you need to be consistent. Most real estate investors really need to be on a cash basis, but there's other reasons why you may want to be on accrual or hybrid. But you want to be consistent in terms of the accounting method that you choose. Number 5, not taking the full amount of loss in the year or any growth year. So it's, some people say, oh, I don't owe any taxes, so I don't need to look for deductions. But guess what? If in following years you start to generate income, and this happens a lot, especially with real estate investors, where you incur a lot of huge upfront costs with educating yourself, taking a look at properties, advertising, and all of that. Because you didn't make any money and you don't owe any tax, you feel, oh, I'm not going to take these deductions. Well, if you don't take those deductions on your tax return, you will not be able to carry it forward. So sometimes it's not just filing tax returns because you don't owe any taxes. Sometimes you file tax returns so that you are able to carry forward losses into another year. If you're in a retail business, and this is mostly for my business owners that use, money from their business to invest in real estate, not reporting inventory. It's expected that if you're in the retail business that you will have inventory, so you definitely want to make sure that you are reporting inventory. Another mistake is making a mistake with your salary. If you are in a multi-member LLC structure or a single-member LLC structure, you don't need to pay yourself a salary. You can have a guaranteed payment from the business, but you should not be paying yourself a salary. If you're in an S Corp, you are required to pay yourself a salary. So it's possible to make a mistake where you think, so as an S Corp, I'm not going to pay myself a salary, or I want to pay myself a salary even though I'm in a partnership. Those two things are mistakes that you can make and end up triggering an audit. Mistake number 8, not setting up an audit defense. One of the things that we need to think of as a real estate investor is your chances of being audited are high simply because of the industry that you're in. So you definitely want to make sure that you're avoiding any kind of red flag triggers on your initial filing. Make sure that you're fully disclosing things on the tax return. Make your overall reporting consistent. You don't want a situation where this year you file a Schedule C, then another year you file a partnership, then another year you go back to file a Schedule C. Those kind of things raise inconsistencies and could trigger an audit. And also keeping good records. Usually I advise that you keep your records for as long as 5 years. Some people say 3 years because that's the only years under audit. I say 5 because if the IRS audits you and maybe for some reason you made a mistake that is due to negligence, they can go back and open up the previous year. So you definitely want to make sure that you're keeping good records. Make sure that you react to any IRS inquiry or audit notice. Don't just ignore a notice simply because you feel, oh, I don't owe that money or it's not right. Don't ignore any IRS notices. Make sure that you respond. It's much better to respond than to be quiet. Tips for automatic pre-audit preparation, make sure that you have receipts. I talked about our stage, one of the stages that we go through is bookkeeping. During the bookkeeping setup, one of the things that I advise clients to do is never to do cash withdrawals from a bank account, or to do balance transfers. You always want to use checks or a debit card or a credit card statement. The reason why you want to do that is because at the end of the month, with just the bank statement, and especially you want to make sure that you're getting back electronic copies of the check, you're able to use that as a receipt rather than having to keep receipts that sometimes they end up fading or you lose those receipts. So make sure that as a business owner that your receipts are tracked in your bank account by making sure that you're using debit cards and you're using, using checks rather than withdrawing money and using the money to go and pay for something. If you pay a related business bill by check, you want to keep the invoice along with the canceled check. I've seen instances where the IRS will accept a canceled check, but if it's a huge item, a huge amount that you have on there, you want to make sure that you keep the invoice as well. Now, this next one is very important. Make sure that you have a mileage log. If you use your car for business, make sure that you have a log book in your car that's tracking mileage. For my clients, we have something that we call a real estate activity log, and it has about 120 different activities that real estate investors can use. And it's an Excel worksheet. And then you go through and you record each week what activities that you engaged in. So if you, went out and visited a property, you put in how many hours you spent, how many miles you spent. If you, had to interview somebody about a property that you were looking at, or if you had to go out and get financing, you're able to keep track. And it's not just for the IRS, it's also for your own record keeping, because you're able to go back and look and see where you're spending your time. You may find out that you're spending a lot of time looking at properties and not enough time, making sure that you have the finances in place to purchase the properties when the time comes. So there's reasons why I suggest making sure that you maintain a mileage log and a real estate activity log. Also make sure that you have your appointment book. I've had clients that have gotten audited, and the reason why they passed the audit is because they had their appointment book. And they were able to show that on this date I had this business meeting, or I had this business lunch, and these were meals and entertainment that were on there, and I'm able to get those deductions. Keep a copy of every invoice that you send to a client on the check stub. Use separate bank accounts for your business. Commingling, not only does it create bookkeeping headache, but it also creates a headache if you get audited by the IRS. Because now the IRS is having to look at your personal statements and can start to pick out items on there. Whereas if you were being audited for your business and you present a business bank statement, that's all they're going to be looking at. So you definitely want to keep a separate bank account for your business. I'm going to open up the line now and hand this over to TJ. TJ, are you there?
I'm here.
All right.
Can you hear me?
Go ahead and take it away. Yes, we can.
Okay, great. Albert, thank you so much for that information. Actually, that information was pretty pertinent to me, as I got an audit for 2010 just recently, and so thank goodness I do have a good accountant, and I have most of that stuff already lined up. But that is all that stuff is very practical and pertinent, especially whenever you're coming up upon an audit. So
yes, and it's very important. I wanted to stress, a lot of people say, oh, I don't even want to get audited in the first place. Sometimes it's unavoidable as a real estate investor. Because of the industry that you're in, you are a high target for an audit. So we tell you things that you need to do to prevent an audit, but also you also need to be ready if an audit does occur. I don't want you to go away thinking that, oh, once I do all these things, I'm not going to get audited. You are reducing your chances of getting audited. But if you do get audited, there are things that you need to have in place. And I see some questions here. We are going to answer all questions at the end of the call. So hang on and stay till the end, and we will open it back up for questions. Go ahead, TJ.
Great. Yeah, wonderful information, Albert. So, yeah, I'm going to talk about, if you could go ahead and move on to the next slide, please. Once again, my name is TJ Bencho, co-owner of Aurora Real Estate Investment Services, and we've renovated hundreds and hundreds of rehabs. And so we've learned a little bit through that process. And what we're going to cover tonight is knowing your market, the do's and don'ts for all types of neighborhoods, and renovations based on neighborhood type. You might be asking yourself, what do you mean by that? I'll get more into that as we go. Can we move on to the next slide, please? The next slide is going to be all about knowing your market. This is, believe it or not, when it comes to renovating buy and hold properties, this may be one of the most important factors. It has nothing to do with actually the renovation, the physical part of the renovation. It's the knowledge part of the renovation. What I mean by knowing your market is do your market research. Go into properties in your neighborhood. Go into those rental properties or flips, depending on what type of investment you're going to do in that neighborhood, and see what type of renovation is going on in that market and what's happening with those type of renovations. You want to know, based on the renovation, is that investment property renting out? Is that flip actually selling? That's going to tell you what you need to do to your investment property. I use the neighborhoods labels of A, B, and C neighborhoods. I always take my renovations about a step or two above the rest of the renovations in that neighborhood. That makes my properties that much more attractive. When I talk about an A neighborhood, I'm talking about a high-end rehab, primarily an owner-occupied neighborhood, probably about 90 to 95% owner-occupied. What I mean by that is 90 to 95% of the people in that neighborhood actually own their home and they do not rent. I usually only flip in this type of neighborhood because my renter pool is so small, only 5 to 10%, and my carrying costs are so high. These are my flip neighborhoods. When I talk about a B neighborhood, I'm talking about a neighborhood I'm using a little bit less expensive rehab materials. That neighborhood is about 70 to 80% owner-occupied, and I do both flip and rent in this type of neighborhood, depending on what my long-term strategy is with that home or that area. In a C neighborhood, this is where the bulk of my properties are, the bulk of my owners' properties are. It's a 60 to 70% owner-occupied, which gives me a large rental pool. I use rental-grade materials. They're still quality, but they're the right price that allows for the right return, and they're a certain material that is meant to be long-lasting. I primarily rent in this type of neighborhood. I do not do flips in a C neighborhood because my pool of potential buyers is a lot smaller. Now, I'm going to start off talking about the do's and don'ts for all types of neighborhoods, whether you're renovating in an A neighborhood or a C neighborhood. As you'll notice, I did not mention a D neighborhood or an E neighborhood because I will not invest in those types of neighborhoods. Those are the types of neighborhoods where it's primarily all government housing. It's not the type of neighborhood that I would feel comfortable going in. I use real estate investment as a tool to help me grow myself and free myself and my family financially and my investors, not a place where I choose to risk my life. So D neighborhoods, although you can make money there, they're not part of my strategy. So no matter what type of home you are renovating in, what type of neighborhood you're renovating in, I recommend do not keep the cast iron drain stacks. These cast iron drain stacks, as you can see this picture on the left,
Hey, TJ, did we lose you?
stack,
All right.
and next thing you know, you're tearing out walls to replace your drain stack.
Okay, looks like we lost TJ again. We're going to wait for him to come back on. While we're waiting for him to come back on, I had a question on whether I'm recommending that you not pay bills electronically. No, I'm not saying you shouldn't pay bills electronically, because if you pay bills electronically, it will show up on your bank account. What I'm not recommending is when you do a transfer from an account in such a way that when you get your bank statement, it does not reflect on the bank statement the name of the company that you paid it to, let's say like Verizon, and it just shows balance transfer, money that went out. So one of the things that I recommend is if you're going to pay a bill, make sure it's paid in such a way where it's like automatically deducted out of the account, like to a check withdrawal. If it's a bill pay, that is going to show the name of the company that it's being paid to. That way your bank account serves 80% of your needs in terms of substantiation for your expenses. And then when you have other instances where you have large items, then you can look for the actual invoice to take care of those items. If there's any other questions while we wait for okay, can everybody hear me? It looks like everybody's still saying that the sounds are gone now. Can you hear me now? Well, good. Okay, so it looks like you guys are hearing me, but it's just Okay, so if you have any questions, please feel free to type it away while we wait for TJ to come back on. I apologize about that. All right, we have a question here while we wait. How do I feel about LLC with S Corps as the members? There's no problem with having an LLC as S Corp with the members. Like I said, I generally don't like to give entity structure and advice without having the details because it depends on what kind of structure that you have and the real estate strategy that you have. Based on the real estate strategy that you have, the answer might be yes or the answer might be no. Usually I say it depends on what your real estate strategy is and what it is that you're trying to accomplish. Let's see if we can get TJ back on. Okay, looks like we're not able to get TJ back on, so we'll just keep answering the questions, and if he's able to comment up at the end, we will do that. All right, what state do you recommend to set up an LLC? And this is a very good question. I usually recommend setting up an LLC in the state where you're located. I've seen a lot of out-of-town groups. They'll form in Wyoming and Nevada and Delaware. But here's one of the common sense questions I usually ask. If you are going to get sued, where are you more likely to get sued? You're more likely to get sued in the state where you're operated, in the state where your property is located. And so it makes sense that you want your LLC to have local standing. And let's say, for example, that you do have a property, an LLC in Wyoming and maybe a property in New York. If you're going to protect that property that is in New York, you will still need to register that Wyoming LLC in New York, or you're going to have to place the property in the Wyoming LLC. So either way, no matter which way you look at it, you're going to have some kind of presence in the state where you're doing business. And that's why we usually recommend to go in the state where you're doing business. I'm going to try to see if we can get TJ back on. TJ, are you back on?
Can you hear me?
Yes, I apologize. I don't know what happened, but you're back on.
Sorry about that, guys. We just had some technical difficulties. So the last thing, what was the last thing you heard me say, Amber?
You were on the do's and don'ts for the different neighborhoods, and you definitely said that we should not use a cast iron, and you were showing us the picture.
Right. The cast iron stack rots from the inside out. So even though it looks good, as you can see, the cast iron stack on the left-hand side looks good, it's rotting from the inside out. That's why if you look on the right-hand side, you see the PVC stack. That's what we use. That'll last a very long time, and it does not rot. Also, you see that we use PEX plumbing. It's the red and blue lines that you see running on the right-hand side picture. Up here in the Northeast, we get a lot of very cold weather, and you want to use plumbing that allows for that cold weather and prevents damage. That PEX plumbing expands 3 to 4 times its own size without bursting, which is very, very critical when you're in cold weather. You never know. You might have a furnace go out and you don't know about it. The place gets very cold. You want to protect your house. It costs a little bit more money up front, but saves you a lot of money in the long run. I recommend not keeping old faucets and spouts, etc. They just cause you problems. I'm looking at this from I like a passive income. I like something that I don't get service calls on, and replacing faucets is something that stops you from getting service calls. Do it while you have your guys in there, and even if the faucet looks good, replace it. That way you don't have to worry about it for a long time. As far as electrical goes, don't keep old wiring in service on the interior or exterior. Do upgrade the wiring and service, interior and exterior, where needed. As you can see, this will just provide you with long-term passive investment, an investment that's up to code, the best investment possible, and it will allow for long-term stability with your tenants because they won't have electrical issues. Can we move on to the next slide, please? As far as the hot water tank, you may be surprised to hear this one, but don't replace if not necessary. I'll keep a hot water tank if I think it has 2 or more years left on it. That's sometimes pure speculation, but the fact of the matter is if I can get 2 years of rental income before replacing my hot water tank, I will do that. I would rather use the tenant's money, the money I made on the property 2 years from now, than use my own money right now. If you are able to test it, do that. A lot of times when you're buying a bank-owned property, you're not able to do that, but if you are able to do that, do that. Do put a new one in if you determine the current one has less than 2 years. Normally you can see the date that it was installed. If it's 15 years old, then you probably have less than 2 years on it.
And TJ, aren't you able to get, but if you do the home, the warranty on those, that if they do run out after the 2 years, that you're able to get it replaced for free? Like I use American Home Shield.
I use American Home Shield on homes that are for sale by owner or are listed on the MLX by the owner. But when you're doing a lot of these bank-owned properties, that's not applicable. So it all depends on the particular property and if it's applicable or not. But, that's always an option to look into for every deal. Some of our investors use that, some of ours don't. It depends on usually it depends on how livable the home is. If it's a complete gut job or pretty much down to the bones, we don't do that because we're putting new stuff in it anyways. That's a very good question, though. In regards to the furnaces, I pretty much have the same advice. The only thing is if you have a 20-year-old boiler, chances are that boiler is going to last you another 20 years. I love old boilers. They last a very long time, so I normally don't replace them. As far as basements, my don't is do not freak out if there is water. This is something that scares off a lot of other people. It's something that is a big money maker for us. We do enjoy seeing water in the basement because it's easy to fix. Sometimes you can just reroute the downspout, as you can see in the picture on the far left. Sometimes all you have to do is jet out the sewer, and sometimes you have to put a French drain in, either interior or exterior or both. But a lot of times it can be fixed with a simple reroute of downspout or jetting out of the lines. Something that most people don't know, and they'll pass on a property because of that. We'll get the property for much cheaper, and it turns out to be a really good investment. So as far as the roof's concerned, don't replace it if not necessary. What we look at is trying to repair it instead of replacing it if possible. Okay, once again, we want a passive investment. We want a stable investment. We don't want damage in our home. We don't want problems with our tenants. But sometimes you're able to repair a roof. Sometimes there's been damage from wind or hail or other types of weather that you can go up there and repair that portion of the roof. Sometimes the roof doesn't need anything, but sometimes it does need replaced. And knowing that is very important. This can be a big cost you run into if you don't look for the things that you need to look for ahead of time. Just because there's no leaking doesn't mean that the roof may not need replaced. You need to inspect it to decide if it needs replaced. You need to look at the condition of the shingles, such as curling or missing shingles or cracked or worn out shingles. Those are all warning signs. Check for interior damage from roof leaks. What most people do and most potential investors do is when there's an attic that you have to crawl up into or you have to use a ladder to get into, they won't do that. That's a big mistake. If you go up into that crawl space and you take a flashlight, that's what the picture on the far right is. That's one that we went up into with a flashlight. And we seen that damage, and we were able to account for that in our costs. Where if we didn't, then that would have been a surprise to us. We were able to actually repair that roof and not replace it, believe it or not. Do replace or repair if any of the above is occurring. Next slide, please. Exterior walls. Do not, I repeat, do not leave worn out and missing mortar from the brick building. You see that picture on the far left? That's very important because water will get in between that brick, and it will get in there when it rains, and it will freeze in the winter and cause much more damage. Not only that, it will get in that brick and will get down into your drywall or into your basement and cause a lot of unnecessary damage. You can have somebody repoint that at a very reasonable cost and prevent yourself a lot of long-term damage. If brick is painted, you can sandblast it, and then you don't have peeling paint, and it looks much nicer. As you can see, the picture, the second picture from the right was painted. The picture on the right is after we sandblasted it. It looks much nicer. Do replace siding if necessary for operation and renting of house. I'm not huge on replacing the siding, but this particular building, you see the one on the left, it was an eyesore to the neighborhood. Water was getting in the property. It's a 4-unit building. We replaced the siding, and we redid the whole inside. But by replacing the siding, certain things happened. First of all, the mayor of the town called us, and he was ecstatic. The property's directly across the street from one of the parks in the town. This changed the whole look of the area, made it feel much more welcoming and nice. Also, we rented out this 4-unit building in about 5 weeks. And a large part of that was because of the new siding, and we've had no problems with the interior. In this case, it was very, very beneficial to replace the siding. Now we're going to talk about renovations based on type of neighborhood. I'm going to go by room to start out. We're going to talk about bathrooms. On the top line, I'm talking about a neighborhood. For an A neighborhood type of renovation, what I do in the bathrooms, I do things such as a stone wall in the shower. I don't do that in every A neighborhood renovation, but those are things that I add to the neighborhood that help my property to sell. This is a flip that we have going on right now. We use high-end slate flooring. We use a high-end vanity. Make it very attractive for the AN type of neighborhood, for the flip, for the resale. Now this is, the middle one down is a rental we're doing in a B neighborhood where we actually have it on the market for $1,300 a month. I use a high-grade towel for the tub surround. As you can see, the tub surround is a nice multicolored, actually it's a slate towel. I use a high-grade towel for the floor or a nice slate, and I use a high-grade stock vanity. It's not a custom vanity, it's a stock vanity. So my material costs are less, but it's still a nice high-end, very attractive to get $1,300 a month for a 3-bedroom home. Now, when I go into my C neighborhood renovations, these are the bulk of what I do, and you're going to find that I'm using a lot of stock stuff, but I use stuff that's above the grade of the neighborhood. For instance, you'll see I do a ceramic towel tub surround if I am replacing it. If the tub surround that's in there is in good condition and it's operable, I will keep it. But if I am replacing the tub surround, I will use a ceramic towel tub surround. I will not put one of those cheap plastic tub surrounds in. I find that they're not attractive, and they cause me more problems in the long run. These ceramic towel tub surrounds, they're a step above what's happening in the neighborhood, and they really attract people. One of my number one ways I get new tenants is from my current tenants. My friends and family of my current tenants, when they come and visit my tenants' houses and realize that they're paying about the same amount of rent as they are, and they have ceramic towel tub surrounds, they have ceramic towel flooring, they have Aurora flooring, they have Pergo flooring, they call me and they want to rent off of us. I use Aurora or ceramic towel flooring in the bathrooms and the kitchens, as you'll see. That's actually Aurora flooring is a floating floor. It's like it's a little bit higher grade it's a little bit more costly than a ceramic tile, but it lasts a lot longer. And I use a stock vanity if I'm replacing. I get all my materials at Home Depot, and I have good deals that I get at Home Depot. In my kitchens, if I'm renovating an A neighborhood kitchen, I use custom cabinets. I use a ceramic tile backsplash with maybe a design, something to make that area stand out. I use custom countertops. I use high-end appliances, and I use high-end fixtures. I need to make my property pop. I need to make people want to buy that property. In my B neighborhood, I use a high-grade stock cabinet. Okay, I don't use the basic stock cabinet, but I use a higher-grade stock cabinet, which is very attractive, but it's still less costly than my A neighborhood custom cabinet. I use a high-grade tile floor or even a medium-grade slate floor. I use stock countertops. I use medium-grade fixtures and medium-grade appliances. Now you're down to C neighborhood, my straight rental grade rehabs. I use the stock cabinets. I use Aurora flooring if I'm replacing it. If I don't have to, I don't. I use stock countertops if I'm replacing them, and I use stock fixtures. I use the basics. Still looks really nice, still very quality. It just doesn't cost as much. Okay, now the flooring. This is in all the living areas, not the kitchens and the bathrooms. In my A neighborhood renovations, I use real hardwood flooring or a very high-grade pergo, but normally real hardwood flooring, and I use high-end carpeting. As you'll see in my C-grade neighborhoods, I do not put carpeting in. In my A's and B's, I do put carpeting in, especially A's. People that are buying a home, they like carpeting in their home. They take good care of their carpet. In my B neighborhood, I use a high-end laminate, not hardwood, and I use a medium-grade carpet. I only put carpet on my B-grade neighborhoods only in the bedrooms because if it's gonna be a rental, only in the bedrooms. Because still it's a rental, and people don't take care of the carpets as good as we do, as you do in your own home. So for the most part, I mean, that's a generalization. But it's a way to keep your costs down. My C neighborhoods, I use stock laminate and no carpet in the living areas. The reason for that is that what I found is that carpet became one of my top expenses when I first started doing this. I would put brand new carpet in the house and find when that tenant would move out, I would need to replace the carpeting again. By going to the stock laminate, it's a little bit more costly up front, but in the long run, it saved me thousands and thousands of dollars. I thank you very much for the time. I hope that my information was helpful. If you have any questions regarding rehabs, you can contact me. My contact information is right in front of you. And, you know, I invite each and every one of you to come spend the day with us in Pittsburgh, to get to know us, to come see our rehabs firsthand, to come see our beautiful city. We've been ranked the #1 most livable city 2 years in a row. Our unemployment rate is 2% below the national average. We have 15 Fortune 500 companies here, and we look forward to getting to know you.
Thank you, TJ. This was absolutely great information. I feel like I need a rehab and certificate. We're going through this. This is very, very good. Hey, guys, I appreciate you guys staying on. We do have a lot of people on the line tonight with a lot of questions. We will keep the lines open because of the delay that we had and try to answer as many questions as possible. So if we don't get to your question, please be patient. We will not get off the call until we get all the questions answered. Again, if you want to contact TJ, his phone number is 412-498-2790, and his email is tjbencho@comcast.net, or you can visit him on the web at www.investinpittsburgh.net. And if you would like to reach us at the Wealth Building CPA, our phone number is 301-559-0126, 301-559-0126, and our email is info@wealthbuildingcpa.com, info@wealthbuildingcpa.com, and our website is www.thewealthbuildingcpa.com. So we will go back to our questions so that we can get through these as quickly as possible. I stopped at where I was answering the question about what state to form an LLC. My short answer is you want to form an LLC in the state where you are doing business. I'm not a fan of registering in Wyoming and Nevada and Delaware. At the end of the day, you're going to get sued in the state where you're doing business. How many homes do you purchase in one LLC? The answer is it depends. There's not a one-size-fit-all answer to this question. If there's significant equity in the property, I say you definitely want to do one LLC per property. The other strategy is that if you're going to purchase these houses in the one LLC, then you definitely want to make sure that you're putting a lien or a second mortgage for the value of the equity that you have in the property. Now, if these properties are buy, rehab, and sell, so these are just straight rehabs, you're not holding on to them, you definitely can buy as many as you are because, it's inventory. And, as you sell one, you're getting the other one. You can do them all in one LLC. But if it's a buy and hold strategy, it usually depends on the equity that you have in the property and whether there's a first mortgage or a second mortgage. I usually would not suggest that you put two properties together when one property has equity and the other one does not, because if you get sued on the property that does not have equity, they can have access to the property that has equity. And let me say this, hopefully I can explain this in a very short time. Whenever you're worried about lawsuits, you need to worry about the top-down creditor and the bottom-up creditor. Now, I know, most of my clients know this, but I wanted to repeat it, that putting a property in an LLC will protect you from the bottom-up creditor. This is a creditor that can come after you personally or that can come after the property personally. They will not have access to you as an individual. So putting a property in an LLC will do that. But it necessarily may not protect you from the top-down creditor. This is a creditor that can go after the property itself. So if you've taken a property out of your name and put it into an LLC, now the LLC has a $50,000 or $100,000 equity. If somebody slips and falls in front of your property and they decide to sue the LLC, they will still have access to that $100,000. So you've succeeded in protecting the property from the bottom-up creditor, but not from the top-down creditor. So you want to make sure that you're taking both creditors into account by making sure that not only do you want to put the property into an LLC, but make sure that the LLC that is financing the property is different from the LLC that is purchasing the property and different from the LLC that is going to hold the property. I used to work for Marriott, and in working for Marriott, that's where I learned this strategy. The management company is different from the holding company, is different from the financing company. So that whenever somebody decides to sue their property, they're going to see that this is who holds the property, but there's not necessarily any money in it. The equity has been stripped off that LLC and put into another LLC. What will happen if you deduct the full cost of education in 1 year? You possibly could expose yourself to an audit. If you did a rehab and generated income, I use this strategy sometimes for some of my clients. If you did a rehab and you have income, I may make the case that it's because of the education that you were able to do the rehab and deduct the full cost. But if you're having deductions with no income, I would be very careful about deducting the full cost. I mean, you can do it and just take your chances on getting audited or not getting audited. Of course, if you don't get audited, then it's not an issue. But if you do get audited, it is going to be disallowed. I'm new at this. I didn't file taxes since I started my business, and I failed to save receipts. Most of the purchases do tell what was about airline, ticket, hotel. How much trouble at this point and what can I do? It depends on how much we're talking about. I'm sure you guys are pretty much can tell by now that my answer usually is it depends. How much are we talking about in total of expenses? What year? What is going on since you started investing? These are things that would help me to determine whether you should let it go or go back and treat all of those as startup costs that you failed to deduct, or whether it's worth going back and recreating your return for those back years. what is a good monthly cash flow for a rental property? I'll give some examples on mine, and then I'll let TJ share on that. For my properties, I have some of my properties where I'm getting $200 a month. Other properties I'm getting $300 a month, and I've gotten as much as $650 a month on cash flow. But I'll let TJ, when you do an analysis, what is a good monthly cash flow? For me, I'm not just looking at the immediate cash flow. I'm also looking at my equity buildup. So some of my properties I financed over 15 years rather than over 30 years. And because of that, my cash flow is smaller, but my principal reduction is higher. So in that case, at the end of the day, I may not necessarily be getting cash flow like physical cash, but I'm paying down my loans faster, and so I'm going to be able to, pay off the property in a shorter period of time. TJ, you want to take a stab at this?
Amen. I agree, Bear. There's so many different ways to look at it, but my number one factor when I'm looking at a property is not the amount of cash flow I receive. It's the return on my investment. I look for a return on investment of anywhere over 12%. You could go to my website, www.investinpittsburgh.net, and look under properties, and you can look under available deals or prior deals and see what numbers I use to figure out my return, my cash-on-cash return. And the way I look at it is if I was saving money and I had it in some sort of investment that was making me, say, 2 to 5%, and I can invest in a hard real estate that, broken down by the numbers, is giving me, say, 13 to 15%, and that doesn't include for my write-offs I'm going to get, my depreciation, my appreciation. That is a great investment. So the amount of cash flow varies depending on what you do. On a single-family residence, if you buy it all cash, you're going to be looking for about $400 to $600 a month positive cash flow. But if you're financing it, you're going to have less out of pocket. Your actually return on investment should go up. You have less money out of pocket. You have less positive monthly cash flow, but your return on your investment goes up. If you don't fully understand that, I'd be happy to go over that with you more after the call. Tomorrow. But I don't look for a positive monthly cash flow. I just sent out a building today where your positive monthly cash flow, it's 3 one-bedroom apartments in a B neighborhood. Your positive monthly cash flow is $1,857 a month. That's a really nice positive monthly cash flow, and your return on that is a little over 13%. So once again, like a Bear said, it is what are you looking for? A Bear is similar to me in that she bought some of her investment properties probably when it was a little easier to get financing on investment properties. And what my goal was there was to get as many properties as possible using leverage, and then to put them in a position where the tenants were going to pay them down so that I own property free and clear. And at that point, my cash flow goes way up. Plus, I have all equity in my property, so if I ever need to liquidate, it would be very easy. So to answer your question, there is no simple answer. As a Bear said, it depends. It really does depend.
For me, I usually don't worry about cash flow because even if I did have the cash flow, the money is going back into the business, and so I don't worry about it. And the reality is, you might have some years where you have very good cash flow, but then in the following year, sometimes depending on the tenant that you have or if something happens in the basement, all of that is eroded. So usually I don't just look at cash, but I look at equity and, like TJ said, cash-on-cash return and the kind of financing that I put in it and how long it's going to be before I own the property free and clear. Moving on, this is for you. Joelle wants to know if TJ, do you recommend using 42-inch cabinets?
And it depends on the neighborhood grade and what else is going on in the neighborhood. Really, the cabinets depend on the type of neighborhood. I use my stock 30-inch or 32-inch cabinets in my C neighborhood. In my B neighborhood, I would go with a 42-inch cabinet. That's attractive, having more cabinet space. Plus, it also depends on the size of the kitchen you're working with. You don't want to eat up all your room in your kitchen with cabinets. So that once again all depends, but that is an added bonus if you have the room and if it's not going to price you out of your market. That is a very nice added bonus.
Okay, now this one is just a comment. Thanks, guys. I look forward to meeting you and buying some great deals. For those of you that were not on the call earlier, TJ does have either one-on-one meetings and tours where he will take you around on his properties, or sometimes he has a bus tour. So if you're interested in taking a look, even if you were thinking about investing in another state, I still would advise you to go to Pittsburgh. I invest in Pittsburgh. It's good to develop relationships and see where other people are, because that way you have something to compare. And, you know, like I've always said on the call, I've never had a problem with my Pittsburgh property. You know, it's never been a place where it's been empty. I've had it since 2005. You know, as the lease is coming due, either the people they're renewing the lease, or I have offers to get the property rented way before the old tenants move out. So I strongly encourage you to visit Pittsburgh. I don't know, something happens when you physically go out there. There's a question here. What contracts do you use with your contractors? Can you share that? So TJ, I guess this is for you. I have a contract that I use, but I guess they want TJ's contract, not a Bear. Thanks, TJ.
They can, you know what, a Bear, you can send them your contract. See, I'm a licensed contractor, and I use primarily subcontractors. I don't sign a different contract per deal that I use. I have their insurance. I'm on their, you know, I'm an insured, additional insured on their insurance. But we do so many deals together on a regular basis that they pretty much know what they're going to get paid for what they're going to do. It's a cookie cutter system. I have a certain electricians I use, certain plumbers, certain drywall people, certain carpenters, certain finishers, roofers. So it's an ongoing thing. We continually have anywhere from 4 to 8 homes in renovation in the pipeline. So I don't sign another contract with every contractor. But, you know, that might be something that a Bear can provide. I am the contractor. So if you want to see a sample of my contract, I can send you a sample of my contract that you would sign with me, my renovation contract. You just send me an email and ask me for a sample of that, and I'll send one over to you.
Yeah, and I think you brought up a very good point. For me, because, you know, my long-term strategy is buy and hold, I've developed relationships with different contractors in the different states that I'm in, you know, North Carolina, Pittsburgh, Maryland, New York. And what I do is I just call these people up and say, hey, we need this thing fixed. They call me and give me a quote. And pretty much because I manage these properties myself, I can tell, you know, whether what they're telling me is reasonable or not. So I do have contracts that I use, but it's very important what TJ said. We've developed relationships with some of these guys over the years that we no longer need to use contracts. And sometimes, you know, those contracts, you know, it's neither here nor there. So for me, I agree. Some of my properties, I don't even have contracts anymore with the contractors simply because I've had long-term relationships with them. Joelle, you asked the question, what if you have a property purchased through a self-directed IRA? I don't understand what the question is. So can you tell me, if you have a property purchased through a self-directed IRA, then what? What is the question you're asking? And then I'll come back to that. Please repeat the 3 LLCs when the strategy is buy and hold. Oh, I said it can be a single member. It's actually 2 it's going to be your financing LLC. This is the LLC that brings the money. And then it's going to be the holding LLC. This is the LLC that holds the property. And then it's going to be the managing LLC, the property management LLC, the one that manages the LLC. So we want to keep them separate. The LLC that's holding title is different from the LLC that's, you know, put up the cash, is different from the LLC that's managing the property. I have a property in Missouri. I would consider putting a small lien on my house to renovate it so I can get a tenant. There is no mortgage There's no mortgage. I bought the property in a tax deed sale. How do I go about that? Because of the time that we have on the call, we're getting ready to wind down. I would ask that you please contact me personally so we can talk about this. My phone number is 301-559-0126, or you can send me an email at info@thewealthbuildingcpa.com, and so I can answer. I guess what you're asking is how you would consider putting a small lien on your house to get money to renovate the property. I think the quick answer is if you're going to do it, you can do a line of credit. And a line of credit automatically would get a lien on the property. And then the property that you have in Missouri, you can put a lien on it for that money. And if you call me, I can tell you about the paperwork, working with a lawyer to get the loan package executed. It's really simple. It's not as complicated. It's called a security deed is what you're going to be executing. But, it's kind of like a long thing that I need to explain. So if you give me a call, I'll explain to you exactly how it's going to be done. I am selling a rehab or handyman special in a CD neighborhood. I am waterproofing the roof and cosmetic work in the front for curb appeal to make it stand out from the other rehabbers in the area. Do you have any other suggestions for me? TJ, this is you.
Is it are you selling to, I take it that you're selling to a end user, not to another investor. And if you're selling to an end user, a huge selling point is to make sure your plumbing is upgraded, make sure your electrical is upgraded. That's something that you if you're using a realtor, you want to teach them how to sell that and teach them how to make sure that when they're looking at other homes in that neighborhood to look for that and tell them about the cost and problems that that's going to cause in the long run. Most people who flip homes in C and D neighborhoods, they do not do that, and when it's pointed out to buyers, the difference in that, it's a huge difference. Make sure you have a fresh paint job. Make sure your outside is anywhere where there's paint or loose cement or anything chipping, that looks really fresh. The buyer's eyes are always going to go towards the mistakes. So you want to look at the details. You want it to be clean. You want your doorknobs to be tight. You want your faucets to look nice and fresh. All those little things that, most people walk and say, it's not a big deal. Those are the things the buyers look at, and those are the things you want to take care of. And my recommendation is if you're trying to do for sale by owner, only do that for a short period of time. You're in prime time buying season now. There's a reason realtors make their money, because they have access to a large market. So use a realtor.
All right, and the last question that we have was back to Joelle. She said, if you have a rental property purchased through your self-directed IRA, how are you protected from being? So there is a level of protection when it's in a retirement account, but usually it's going to be the same thing as long as there's some level of cash that has been invested in the property. Because remember now that anybody that's taking a look at that property may not necessarily know that this is owned by an IRA. And sometimes, some of these lawyers, money-hungry lawyers, by the time they go through all that, even just the legal fees that you have to defend yourself. So usually what I suggest is also make sure that the IRA owns an LLC and have the LLC put a lien on the property itself. The goal is that if anybody goes to the public records, we want them to see that this property has collateral on it. It has a lien on it that needs to be satisfied. That acts as a first deterrent, because if anybody wants to sue you and is suing the property, why are they suing you? They want to get access to that money. But if they pull it up on the public records and see that there's a loan, this property is worth $150, there's a loan for $120, you can take the property. You still need to satisfy that lien. That acts as a deterrent. So I'll suggest, even though self-directed IRS is a level of protection, but to even put like what I call an extra step, have the self-directed IRA set up an LLC, and then have the LLC put a lien or execute a loan package on that property. Okay, this is the last thing. Thank you, Abera and TJ. I appreciate this webinar thoroughly. Thank you, too. I appreciate it. It's humbling when I see these many people on the call. One, it tells us that whatever advice that we're giving and teaching and information we're bringing to you is needed. That's the first thing that I'm learning from this. And two, it's teaching me that there's not a lot of people out there who are giving people just pure advice without having to, make you buy something or, go to the back of the room and invest in yet another course that's not getting you anywhere. As we round down, I have our information on here. I thank you all for being on the webinar. TJ, do you have any closing comments?
No, I thank each one of you for spending this evening with us, and it's a blessing to be able to provide this information and to give back and to do this with a bear. We've built a great relationship, and I always get good feedback on our webinars. And so I thank you, Bear, for teaming up with me again, and I thank each one of you. And and Bear and I are here. If you want any more information, not necessarily to work with us, if you just want to grow your knowledge or you have questions on something else you're doing, just let us know, and we're here to help.
Okay, and I see there's quite a number of people on the call, so I'm very impressed tonight. And we will go ahead and round this up. Like I said, if you have any more questions, please feel free to give me a call. You can call our 1888 number on the screen, or you can call the office directly at 301-559-0126, or go to the wealthbuildingcpa.com, or send me an email at info@wealthbuildingcpa.com. TJ, please give out your information again one last time.
Yes, my phone number is 412-498-2790. Once again, 412-498-2790. And my email address is T as in Tom, J as in Joseph, Bencho. So that's TJ Bencho, BENCHO, @Comcast.net. And our website is www.investinpittsburgh.net. That's investinpittsburgh.net. Look forward to hearing from you. Have a great evening.
All right, everybody. Have a great evening. And look forward. We are going to be on same time next month is usually the last Tuesday of the month, and we will go ahead and publish the topic in about a couple of weeks. All right. Have a good evening, and God bless you guys. Bye.
Thanks, Bear.